Chapter 6, Part 2. Inventory is usually a current asset and represents merchandise held for sale to customers. When accounting for inventory, companies must choose cost flow assumption. Under GAAP, their choices are FIFO, LIFO, average cost, and specific identification. Specific identification's applicability is somewhat limited. Companies keep track of each inventory item and expense its specific cost when sold. The method is feasible to use if companies' inventory is comprised of fewer items and they are easily distinguishable. FIFO stands for first in, first out. This method assumes that the oldest items are sold first, therefore they are allocated to cost of goods sold. Grocery stores will most likely follow this cost flow to limit spoilage. It applies well to perishable inventory items. LIFO stands for last in, first out. The assumption under this method is that the most recently purchased items are sold first, therefore they are allocated to cost of goods sold. An example for an activity that can use this cost flow assumption is the sale of periodicals. Nobody wants to buy old news, so the most recently purchased items are sold first. Average cost averages the different inventory prices. Different methods affect differently net income and the inventory asset account. The method adopted by the company has to be noted when the company is analyzed, and this information can be found in the company's notes. In an economy of rising prices, FIFO yields the highest net income because their cost of goods sold will use the oldest, therefore lowest costs. So it will subtract lowest cost from goods sold from sales, which will result in the highest net income. The balance sheet will show the highest value of inventory because the most recent or highest prices are used in its valuation. LIFO will yield the lowest net income because the highest inventory cost was part of cost of goods sold, and its inventory valuation on the balance sheet will be the lowest. The results under the average cost method will fall in between FIFO and LIFO. Companies will choose to use LIFO to pay the lowest amount of taxes. FIFO will make the company look the best with the highest net income and inventory. If the economy becomes an environment of declining prices, the effect of the methods will reverse. The company can choose to adopt either method. They can use more than one method for different classes of their inventory. However, once the company selects its method or methods has to stay with them and be consistent. The change of one method to another is possible, but financial statement restatement will be necessary, and the investment community generally does not look favorably. A manufacturing company will disclose its 3 inventory accounts. They disclose inventory stage of completion. Raw materials are materials used in the manufacturing process, and the manufacturing process has not begun yet. Work in process is partially completed inventory. The manufacturing process has begun, but is not complete, and finished goods are completed inventory ready for sale. To avoid inventory overstatement, GAAP requires companies to use the lower of cost or market for inventory valuation. For example, if an item of inventory cost was $10 and the price on the market drops to $5, the company has to reevaluate its inventory at the lower cost of $5 per unit. You can see that Research in Motion Limited has inventory for $618 million at February 26. Their policy for inventory in the notes accompanying the financial statements is raw materials are stated at the lower of cost and replacement cost. Work in process and finished goods inventories are stated at the lower of cost and net realizable value. Cost includes the cost of materials plus direct labor applied to the product and the applicable share of manufacturing overhead. Cost is determined on a first in, first out basis. Commonly used inventory ratios are inventory turnover, which equals cost of goods sold divided by inventory. The ratio measures the number of times a company sells its inventory during the year. The more times the company sells its inventory, the better, because this is when the company realizes the gross profit. A general benchmark for this ratio is 4 or more, but the industry and its benchmark has to be factored as well. Inventory days equals 365 days in the year divided by inventory turnover ratio. The ratio expresses the inventory turnover in days. This format is usually easier to understand.